Hello and welcome to another episode of Table Talk. Today, my guest is a good friend and the number one mortgage broker for his company is Bruce Lusby. Today, he's going to try to answer some of the questions which you have sent to me on mortgages. So at least at the end, you get a better understanding of what type of mortgages are out there and how they apply to your situation, and maybe have enough information to make better decisions when picking a mortgage for the first time, or when modifying or renewing one that you currently have. So Bruce, welcome to Table Talk.
Thank you, Emo. Great to be here. Nice to chat with you.
Yes, always nice to chat with you. And could you just give people a little introduction as to who you are and what you do and how long you've been in the mortgage industry?
Sure, absolutely. So I've been an independent mortgage broker with Premier Mortgage for the past 5 years. And I've been a mortgage broker in the industry for the past 10 years. And before that, lots of business experience, customer service experience. But I love being my own boss. I love being a mortgage broker and helping people make their reality of dream of home ownership come true. It's fun work.
Excellent. Now, just to add to that, what's the difference between like if I went straight to a bank or just went to a mortgage broker? What are the advantages I get? Just so it's clear as to what you actually bring to the table.
Sure. Well, that's a good question. So as an independent mortgage broker, I'm a consultant and I work for my clients. And as a broker, I offer a whole variety of different mortgage lenders to my clients as options. So, you know, big banks that you would have heard of and your listeners would have heard of, such as, TD Bank, Scotiabank, Manulife Bank, credit unions, are kind of the retail side of the business that I offer to my clients. And then there's a whole variety of lenders called monoline lenders. And they don't have the bricks and mortar of the big retail banks, but they're all AAA Canadian rated banks and lenders, and they are lenders like Home Trust, First National, Merrick's, Lendwise, B2B Bank, RMG, the list goes on and on. There's lots of great lenders and they're very competitive. So if clients really want to deal with a big bank, we can do that. And if they really just want to find the right mortgage solution to suit their needs, then at the best rate possible in the market, then that's what I'll do. I'll go and find them that.
Okay, that's great. So I know most people know the two main types of mortgages, but I suspect there's more to it than that. I've heard of cashback mortgages and all of them. So could you just give us a little bit of the if you want to call it the laundry list of the typical mortgages that are out there and what each one is used for or what each one is good for. And if there's some way to say which one might better suit a certain type of person.
Sure. Yeah, no, absolutely. So really kind of mortgage basics, there's two basic types of mortgages. There's an open mortgage and a closed mortgage. An open mortgage can be paid off at any time and there's no penalty to do so. There's a specific type of client in need to get an open mortgage. Most clients don't need an open mortgage. They want a regular, normal mortgage, which is a closed mortgage. And when I say closed, it means that it's for a set period of time, it's a term. And if you want to get out of that mortgage contract before your term is over, there is a penalty. It's standard for a closed mortgage.
Okay.
Every lender will have a penalty for a closed mortgage. And so with closed mortgages, there are different types, like you mentioned, a cashback mortgage. There are different varieties of cashback mortgages, which can give clients who have the room in their qualifying ratio to qualify for a cashback mortgage, the ability to get some cash back to help with moving or to help buy furniture for their new house, or perhaps to pay down some debt in order to bring their qualifying ratios in line. Some lenders call them a peace of mind mortgage promotion. Basically, you pay a little bit more in an interest rate to get back some cash. So you're you're paying a little more in interest over the, say, the 5-year term, but in advance, you're getting extra money up front. So you end up paying the lender back for that money they're giving you in the cash back in the form of a higher interest rate. But you could go with like a 1% cash back, a 2% cash back, 3% cash back. Some lenders even have 5% cash back.
Okay.
Yep. And there's other mortgage, like a very common mortgage product would be what's called a purchase plus improvement mortgage. And that would be, so if a client buys a house and they want to do a small renovation, maybe put a bathroom in or a kitchen reno, or repaint the house or new flooring, that's a mortgage product. And there's a lot of more details around that product, but basically the client needs to get quotes for the renovations they want to do. They need to pay for those renovations, but then the lender will reimburse them the funds for the renovations after they've done them. The lender holds back the renovation funds until the renovations have been completed.
Right. Okay. Excellent.
But it's a very popular type of mortgage that a lot of the time, you know, when someone finds a house, it's almost perfect, but not just quite. So they can do the purchase plus improvement mortgage to make it just the way they want it.
So then I guess the plus improvement will increase the value of the house, so to speak. And so the mortgage they're giving is based on the new value of the house plus with improvement included.
Yeah, exactly. So that increases the payment. So, for example, if the home is $200,000, the maximum for the purchase plus improvement is a maximum of $40,000 or 20%. So. And they would just make the purchase price $240,000.
Right.
With the purchase plus improvement included.
Okay. Now, another question which I got asked a lot was, how does one's credit score affect the mortgage rates that they get?
It does. For a regular mortgage, the minimum credit score might be, depending on the lender, might be 600 or 620, sometimes a little bit higher or lower depending on the lender. There are special promotions that lenders have. Believe it or not, lenders do have specials and they have promotions and they have sale rates as opposed to their basic normal rates. However, in order to qualify for their special rates or their best rates, you do have to have a minimum credit score and able to qualify for those special rates. So if you want the best rate in order to save money on interest paid, if you don't have the acceptable credit score, you won't qualify for the special lower rate. You might just qualify for their regular rate. So there's that. There are opportunities for someone to save money on their mortgage by qualifying for a lower rate because they have a good credit score, a strong credit score.
So I know
there are basic credit scores that you need just to qualify, period. But if your credit score is high, then you do open up that window to qualify for better rates.
So just an average, and I know, again, I'm sure that the rate might vary between lenders, but what will be good, typically, what's the good credit score to get some of those rates?
Yeah, so like I have a particular lender who has a special promo rate for, it's 720 is the minimum score to qualify for special rate. And they also have another rate, and a lot of your listeners may not understand this, but when you buy a house and you put your offer in to buy the house and it's accepted, the closing date could be anywhere within the next 120 days, the next 4 months.
Okay.
If you choose to or negotiate a closer closing date that's within 45 days or 60 days, some lenders will offer what's called a quick close special rate. So if your mortgage is going to close in a short period of time, say 45 days or 60, depending on the lender, the lender will offer a lower, better rate, a special rate. And if it closes after, say, 45 or 60 days, but before 120 days, then it would be a separate rate, a higher rate. So another opportunity for your listeners to save some money on interest.
Nice. Okay. So a quicker close as opposed to one that takes forever.
Yes. Yeah. Well, and that can take forever. 120 days, 4 months is the maximum.
Right.
But a lot of the time, that's not really necessarily up to the buyer, to your client, because the seller may want to have a closing date that's in 3 months. So
Right.
your client says, "Well, I really want to close in 45 days so I can get that special rate." Um, it might not be up to them. It might not. It might not be negotiable.
Right. Because of what the seller, I guess the seller's timelines also have to come into play. So,
Yes, it's a negotiation. Yeah.
right. Okay. Now, I know that, of course, with the mortgages that I've gotten from you so far, thank you very much. There are a lot of pay down options which we have used. So, when one is looking at different lenders, are the pay down options basically the same, or are there differences that one should be aware of?
There are differences, yeah. So most lenders offer prepayment privileges, so the ability to pay your mortgage down faster, of between 15 and 20%. So that's a lump sum payment right onto the mortgage principal each year, 5-year term of up to, say, 20%. So if you had a $200,000 mortgage, that's $40,000 a year each and every year that you could put right onto the principal balance of your mortgage. That's if
Nice.
some lenders are 15. So that's a lump sum payment that you can take advantage of, a prepayment privilege to pay your mortgage down faster. And lenders are always calculating the interest that they charge a client based on the principal balance. So that's why if you look at an amortization schedule for a mortgage, you see the amount of interest that the client pays slowly, just very slowly, like glacial pace, decreasing
Right.
a bit every month. That's because the client's paying a little bit from the principal down every month. So the amount of interest the bank collects reduces a little bit every month. So for example, let's just say roughly the mortgage is $1,000 a month. Roughly say 500 is principal and 500 is interest. So every month you're paying down your mortgage balance by $500. Consider it forced savings. You're building up equity in your home of $500 every month. If you made a large lump sum payment to your mortgage, say $40,000, that brings your mortgage principal balance down considerably. So let's just say, for example, now that mortgage payment that was $1,000 a month, maybe $600 is going to the principal balance, and only $400 is going to interest. So
Right.
those aren't exact numbers, but that just is a bit of a visual to give you and your listeners an example of how easy and how fast it is to pay your mortgage down faster. So that's a lump sum payment, which you can take advantage of. You can also increase your mortgage payment by up to 20%,
Okay.
but 15 and 20% for most lenders. So if your mortgage was $1,000 a month, you could make it $1,200 a month, and that extra $200 you pay every month, again, goes right on the principal balance, paying your mortgage down faster, so you pay less interest in the long run.
Nice.
And there are some lenders that will give you the opportunity to double up on a mortgage payment as often as you like, whenever you like. Excuse me. So if your payment's $1,000 a month, you could make it $2,000 a month, and the extra $1,000 you pay goes right on the principal every month. And you're not limited to doing the lump sum payment or increasing your mortgage payment. You can do both if you like.
Nice.
Yeah. And I'll be honest, Emo, most clients, they're very interested in the prepayment privileges when they are shopping around for a mortgage, and it's important to them at the time. But I don't think most clients necessarily take advantage of those. They get into the routine of making their monthly mortgage payment, and they kind of forget about it, and they think about it again when it's up for renewal. But that's where you come in to kind of drive
Remind them. Yeah, knock on their doors.
Yes, don't forget to pay down your mortgage as fast as you can. The less interest it's more money in your pocket and less money in the bank's pocket.
Nice. It's good. Okay. Now, another question which I got, and again, I know that nobody has a crystal ball, but The question was more about, especially with the way house prices in HRM have gone skyrocketed up. It was more of, what kind of movement do you think would happen in interest rates for the next, 1 to 3 years, and that's trying to figure out, are things going to be a little bit stable? Are they going to spike up a little bit faster than one would expect? So I guess it's just trying to get some sense as to your thoughts on interest rates and where they're heading in, say, 1 to 3 years or so.
Yeah. Well, I guess I should let you know I'm not an economist.
Yes.
But, a lot of the experts will say that, we are in a very low interest rate market right now. And, because of the pandemic, interest rates have been suppressed, they've been low. Fixed rates have come up over the past number of weeks, and they hinge on the bond yields. So when bond yields are going up, the fixed interest rates will go up. The variable rates are more based on the strength of the economy. So obviously variable rates are very low right now and have stayed low. But, as to your question of what's going to happen in the next year, 2 years, 3 years, as the economy strengthens, as we get through this pandemic and unemployment numbers go down, as people have more money in their pockets and the economy strengthens and people are spending money, you will begin to see interest rates rise, and you will begin to see interest rates try to return to normal levels, both fixed and variable.
Right.
So, I don't have a crystal ball, and even the experts can be wrong. Things like pandemics can really shake things. But, I expect that, I would tell my clients that over the next number of years, you are going to see interest rates rise, and there'll be pressures for them to return to normal levels. So
they can't stay low forever.
Yeah, they can't stay low forever. The economy is going to turn around eventually.
True.
Will strengthen and rates will rise. So we have, the Bank of Canada qualifying rate built into our qualifying process for new mortgages. So it builds in that wiggle room so clients can plan, and the government helps them to plan for interest rate rises. So when they're up for renewal, they've already know that they can afford a higher interest rate, a mortgage payment at a higher interest rate, because the qualifying rate has already budgeted that in for them.
Is that the stress test that I keep hearing about?
Yeah, that's exactly it. Yeah,
okay.
Yeah.
So in simple terms, just so people know, what is the stress test?
Yeah, so the stress test, it's the Bank of Canada qualifying rate, which is right now it's 4.79%. So even though a new client, say they're buying a house right now and it's insured, the rate might be 1.94% fixed. And so that's their contract rate. That's the rate that they're going to pay on the mortgage for the next 5 years. However, in order to qualify for that mortgage, they have to qualify at a payment that's at the Bank of Canada qualifying rate at 4.79%. So
Right.
they qualify at a much higher monthly mortgage payment than they're actually going to be paying. And the rationale behind that is because, it just for our very situation that we're in right now, is that if over the next 5 years, interest rates continue to go up, up, and up, and up, and say you're up for renewal in 5 years and the interest rate is at 4.79%, we already know that you can qualify at that rate.
Right.
And, the Bank of Canada, the government, they don't want clients to come up for renewal and all of a sudden have a really high interest rate and be in a situation where they are saying, wow, interest rates have gone up so much, my payment is so high, I can't afford to make these payments at this rate. I can't afford to keep my home. So when I'm up for renewal, I have to sell my home. Nobody wants that. So
Right.
I have to give them kudos for putting that layer of protection in place to help protect homeowners in that situation.
Right. I think it's better for everyone anyway with that. People might not know it at the time, but when interest rates go up, I think they'll be thankful that that was put in place.
Absolutely.
Right. So I think before I go into the questions on things that new buyers should look out for when looking for mortgages, and things that people already have a mortgage should look out for when going into renewals. I'm just going to ask again. I don't know if I'd asked that earlier on, but in terms of the term of fixed mortgages at this point in time, or sorry, variable or fixed at this point in time, if somebody was on the fence, what kind of advice will you give to pick one over the other?
Yes, and that's good. And I'm not sure how other mortgage brokers handle this, but I personally don't push my clients one way or the other between variable and fixed. I typically like to have a conversation with the clients, explain the pros and cons of each, and then let them filter down to what they feel more comfortable with. And so
Right.
just a quick touch on that would be, if you're variable, the interest rate based off the Bank of Canada prime lending rate. Right now, that's 2.45%. So as the Bank of Canada prime lending rate goes up or down, so will your mortgage payment. And fixed, it's set, it's guaranteed, you can budget for it, it won't change for the entire 5-year term of your mortgage. So a pro of going variable is that the interest rate is lower. So there's savings to be had in the short term, savings to be had as long as variable rates stay low. That's a pro. Another pro of going variable is that it's convertible. So you can convert your variable rate mortgage to a fixed rate mortgage at any time. You just call the lender up, let them know that you don't want to be variable anymore. You want to switch and convert to a fixed rate. And they'll say, no problem. Here's our best fixed rates at the time that you call. And you can basically, put a Band-Aid on it. You can stop any future rate increases by going fixed. You don't get to go back in time and lock into that fixed rate when you put your mortgage in place, but you get the best fixed rate at the time that you switch.
Right.
The pro of going variable is that the potential penalty of breaking your mortgage contract is better. It's a maximum of 3 months of interest if you're variable. If you're fixed, so those are the pros. If the con of going variable is that it is variable, that it will fluctuate and it's not guaranteed. So there's a riskier, it's a client that's more risk tolerant that would go variable. Now, I'll just say that variable rates typically and historically outperform fixed rates, but most clients go fixed because they like that comfort of knowing that their rate is set and it won't change and they can budget for their mortgage payment.
Right.
The pros of going fixed are that it is fixed. It won't change and there's a comfort level there. The con is that you pay a little bit more in a higher interest rate for that comfort level of knowing your rate won't change.
Right.
The other con of going fixed is that the penalty, a potential penalty you would pay if you have a broken mortgage contract, is potentially higher if you're fixed. If you're fixed, your penalty is the higher of 3 months of interest or the interest rate differential calculation. So if you break your mortgage early in the term, it could be a very large penalty.
Right.
If you break your mortgage very late in your term, it would be close to the 3 months of interest. So
Okay.
if your penalty options, if you're variable. But so really, I have that discussion with clients and I go a little more in depth, but really it comes down to what the client personally is more comfortable with. Some clients are more risk tolerant and they would like to go variable because they want to have those savings up front now, where other clients are very conservative and they don't want that risk of knowing that their mortgage payment could potentially change and they'd have to pay more every month for their mortgage.
Right. Well, that makes sense. Okay. Now, Bruce, so if you're talking to new people into the market, what advice will you give them? And then you could also answer for people who are in and want to renew as to what steps to take.
So if someone's new in the market,
First-time buyer.
First-time buyer, I think the first thing that every first-time home buyer has to do is sit down with a mortgage broker. They need to sit down, put a budget in place, and just get a baseline of where they are before they start to get their hopes up and spend time and effort on finding a house that they want to buy. Meeting with a mortgage broker will give them the opportunity to figure out what steps are necessary. We will do a standard credit bureau check to confirm where their credit score is. Maybe they're very aware of where their credit is, maybe they're not. We'll figure out what their debt servicing ratios are, compare that with their income to figure out exactly what they can qualify for. So, are the houses that they're interested within their budget?
Right.
Is their credit score satisfactory for them to qualify for a mortgage? So it gives us a real good baseline to figure out what the next steps are and to help manage their expectations.
Okay. And then for the person who already has a mortgage and is looking at refinancing, what should they do? How soon should they start checking?
Yeah. So what I would say to clients is that, 4 or 5 months prior to the renewal date, we should meet, have a conversation. I'll create their mortgage application to figure out where things stand, what they can afford, what their options are. And then what I can do, I typically do for all clients is I figure out, what it is that is going to offer them for renewal. And then we compare that to every lender in the market. And so if the lender that they're currently with is offering them the best rate in terms, then we simply renew with the same lender. However, if there's another lender out there in the market that's offering a better rate, well, then we can look at the option of switching the client from their current lender to a new lender in order to save them money on interest paid. So that's what's called a switch transfer. That's an option to do for a client. There's no appraisal fee necessary. There's no legal fee necessary. And you can just switch your mortgage from one lender to another lender when you're up for renewal. And it's a very seamless process to save money on interest paid. Now, when you're up for renewal, that's your time to consider all your options. So if you want to do a refinance, if you have available equity in your home, you could do a refinance to pull equity out. So basically, to do a refinance, you're paying off your old mortgage and putting a new mortgage in place for a higher amount, therefore getting some equity to pay down debt and do some debt consolidation, to do some home renovations, whatever you want. That money's yours, that equity is yours in the house. It's yours to do what you want. Yeah. So you can refinance before your mortgage is up for renewal, but there's a penalty to do that. So really, it's if a client can be patient and wait till they're up for renewal, that's the time to consider all your options. So I would like to meet with clients, 4 to 5 months prior to the renewal date. Because 4 months in advance is how far I can confirm and lock in their rate for their new mortgage.
Right. Excellent. Now, I know that this is the point that most people wait or look forward to is that time when you're making your last payment or when you finally pay off the mortgage. So what is the process? When somebody pays off the mortgage, what really happens from the lender's point of view, and also to, I guess, in whatever province they have to go register something to say it's paid off or so. What is that process? What do you have to do?
Well, a celebration first is what first.
Yes.
That's great. Yeah. You know what? So basically, when they make that last payment, believe it or not, there is a discharge fee, and it's for all mortgages. Every mortgage, every single mortgage has a discharge fee.
And who do you pay that to?
The lender. It would be paid with the lender to the lender. Yeah. So some discharge fees could be as low as $150. Some might be as high as $450. But I think around $300 is the typical norm. So basically, the discharge fee is to cover the registration of the mortgage with the province. So every mortgage is a lien against the property for the loan. And all of those liens, those mortgages, are registered with the province. So there's a fee for the lender to register that mortgage, and there's a fee to unregister it. So when the discharge fee, I think it just helps cover the cost of unregistering the mortgage with the lender, and so that's why they charge it. That's my take on it. Yeah, so when the client finishes paying off their mortgage, there would be a discharge fee that the lender would charge as part of that last payment. So maybe if your last payment was, $1,000, then it's $1,300, including the discharge. Yeah.
Now, do you have to take any forms to the registry? I mean, is it land registry's place? Do you have to take any forms there to do something?
You know what, Emo? I'm not 100% sure on that. I kind of feel that the lender would manage that. The lender would close it out, and the lender would take care of that for you, discharging the mortgage. I don't think that the client necessarily has to go to a lawyer to discharge that. I think the lender will take care of that, and that's part of the discharge fee. But I'm usually not involved with the closing. I'm involved with putting the mortgage, not closing out of it. But when a client is so lucky and has worked so hard to pay off their mortgage completely, I do offer home equity lines of credit products, mortgage products, and they are a good financial tool to have in place. Some lenders charge a monthly account fee like a bank would, like an account fee on a bank to have a home equity line of credit. But I do have other lenders that don't charge any fee at all. So if you had, let's say, for easy math, $100,000 home, then you can put a home equity line of credit up to $65,000, 65% loan. So it's basically I like to call it an emergency fund. So if their client had paid off all of their mortgage, they could have this financial tool in place, the home equity line of credit, to quickly and easily gain access to the equity in their home if there was ever an emergency, if they ever did need money to access for something quickly. And a mortgage, the home equity line of credit, is basically an open mortgage. We talked about open and closed earlier. Open mortgage can be paid off at any time. So if you needed $10,000 to fix the roof because all of a sudden there was a leak in the roof, and you didn't want to dip into your RSPs or into your investment account or your savings, you could just write a check, get the access to your equity. Sometimes you can write a check. Some HELOCs, home equity lines of credit, have debit card. Some you just call the lender up and say, I put $10,000 in my account and they'll transfer it. But that money would be yours then to do with what you want. And then you can pay it off by as slowly as making interest-only payments, or you can pay it off completely whenever you want because it is open.
And what kind of rates do they? I know, of course, that will vary depending on what the going rates is. But what kind of rates do you look? Is that pegged towards, the ongoing interest rate, or how does that work anyway?
Yeah, no, that's a good question. The home equity lines of credit are a variable interest rate, and it's based off the prime prime lending rate, which, as I mentioned, is 2.45 right now. So most lenders on a home equity line of credit are prime plus 50 points. So that would be 9.5 would currently be the rate. I do have
2.95.
2.95, and that's an open HELOC rate. I do have one lender that's prime plus 20 points, so they would be 2.65. Now, and so those are the variable rates for the HELOCs, and it's a completely open mortgage product. So some people use them to kind of live in out of, to access funds whenever they need them. But again, if for an open mortgage, it's kind of a temporary solution. You don't want to have your money in there for a long time, because if you have it there for a long time, you might as well fix it into a closed mortgage at a lower interest rate, as opposed to the open HELOC at a slightly higher interest rate. So it's kind of a short-term mortgage solution.
Right.
Yeah.
Okay. And so that's so you could take some cash out of the equity which you already have built into your paid off home if needed. Gotcha.
Yeah. Yeah. Excellent. It's a nice financial tool to have in place.
So when you give the final I guess the mortgage is paid off, then you come and there's some package or some brochures that you give out that people can see to get more information on that. Is that how that That works?
Well, I would just have a discussion with the client, or I could send them an email with some information on home equity lines of credit. Yeah.
Okay.
Yeah. You can also have it. It doesn't have to be. You don't have to have your mortgage paid off to have one. You just have to have available equity in your home to be able to access one. So you know, a lot of people will have, you know, who have a smaller mortgage would also have a home equity line of credit. They can have both.
Right.
Yeah.
That's great. So what I'm going to do anyway, and if people have questions, I want to get a hold of you. I could put your way to get a hold of you anyway at the end of this video, probably in the description of the video. But yes, Bruce, thank you very much for imparting knowledge on us about mortgages. And I am a little wiser for it. So thank you very much. And
You're very welcome.
you've been great to deal with, and I'm glad you've done a couple of mortgages for me and for friends, and I would always come see you because you do a great job anyway. So there you have it. I'm going to give Bruce the last words in this, but to see more videos like this, don't forget to subscribe. Bruce, last words.
Last words, Noel. I just wanted to say thank you for giving me the opportunity to have a chat with you tonight and to share my mortgage knowledge with your listeners. I appreciate it.
Thank you very much. You say hi to everyone from me at your end, and we'll see you soon.
You as well. Thanks, Emo. Talk to you soon.
Take care. Okay.
All the best.
Bye-bye.